Now we have Europe, which saw some inflation accelerating to new all-time highs, and the pace at which is really breathtaking, to be honest with you. And I think that's some of the pressure that we've been talking about. You know, last week we talked a bit about the ECB. We're going to talk again about it in terms of ways that they're going to try to counter some of the pressure points. So when you look at economic confidence, right in line with estimates, industrial confidence slowed down a bit, services right in line, consumer confidence, again, still negative, but same as last month. So the CPI side, so the CPI estimates for May were expected at 7.8%, which still would have been an acceleration month on month. But when you look at what actually came in, it was 8.1%. Now, the CPI month over month was expected at 0.6, accelerated to 0.8, with the core accelerating from 3.6 to 3.8%. So the global Eurozone manufacturing, Eurozone manufacturing was expected 54.4, came in at 54.6. So some of that is because of some negative pieces, prices paid, prices received, but also on the supplier delivery side. But the thing that we want to talk about the most is CPI, because what is driving it? And I think these two charts are fantastic at showing what is driving that piece. And it's no surprise that it's energy. But it's not just energy when you look at some of the non-energy industrial goods and services. So this is something similar to what happened in the US, where you had flexible inflation just driving us higher, pulling us higher. But one of the things that we had said from the beginning is but wait, it's the flexible leads, but it's going to drive core higher, and it's that sticky inflation that's going to be creeping up, and that's going to accelerate. And when you start looking at non-energy industrial goods and services, that is accelerating, and it's not going to slow down. Food continues to be another driver to it, but the euro area inflation of 8.1% breaks another record. And we see it accelerating again, as we talked about in June and July. We don't see Europe slowing down because the U.S. kind of led that show. The U.S. is already kind of moving out of this parabolic inflation to slowing rate of change to stagflation, where Europe is still catching up. They still have that inflationary pressure. And obviously, the Russia sanctions, Russia-Ukraine is not helping their situation, and they are the most impacted from it. Now, the other key piece, which we talked about in the U.S., is the number of rapidly rising prices. So when you look at the percentage of things rising more than 4% is over 60%. So over 60% of the items in Europe have a price increase of over 4%. Again, that is a shocking impact when you think about wages. So in the US, wages at least have been going up. They're not keeping pace with inflation, but they're rising. The wages in Europe are rising, but at a much slower pace than the US. And the consumer in Europe was already in a worse position than the US consumer, which again is why we believe they're already in a recession. They're already seeing slowing growth because the consumer is just not in the same position, and the pressure is going to be real. So when you look at months since last rate hike, I thought this was a great chart. So the last time the Europe, or I should say Euro area, had a rate hike was 130 months ago. And then I thought that was interesting when you think about where we are, where inflation is, and how it's been 130 months since they've raised rates. Now, market implied ECB rate after the July meeting is expected to be at 0.25, a negative 0.25. But then if you take that out to the end of the year, it is expected to be positive. So there is an expectation in the market to have multiple raises out of the ECB. And I think that people could be surprised at the pace in which those increases actually happen. And the reason why is because of these charts and the issues that are not going away anytime soon. This is just showing the Eurozone core CPI and just how aggressive those prices have gone up. while the manufacturing confidence indicator coming down, services. Now, this is going to be something similar. Manufacturing, we think, is going to come down faster, obviously, than services. And services is going to be a bit flat because people are going to try to maintain as much semblance as they can of normalcy. And services is easier, where goods and manufacturing, that has gone up so much. And we do expect that to come down faster. Now, I think this is what is happening in Germany. You can say is happening everywhere, but Germany being the largest economy in Europe, I think this is a very good kind of gauge of the issues in that area, where German nominal wages aren't keeping pace with surging inflation. Real wages are at negative 2%. Nominal wages have gone up to about 3%, but inflation rate and this is at 6%. It's actually at 8% now. So you're getting an idea of just how poor wages have been. But nominal wages have flatlined, where in the U.S. they've had a very steady increase overall. But again, we've had the same impact on real wages because our inflation ran faster, or started earlier than what's happened in Europe. But they're now catching up, and the issues are only going to expand. And this is when you look at German HICP, survey was for 8.1%. The actual came in at 8.7%. Again, that shift from 6% to 8.7 is huge because you're paying more for the same stuff. And the Euro area retail sales, the value index has gone up, but the volume index has gone down. And that's where you're starting to see that flatlining into that. And then we expect to see volumes really start to take a hit as wages continue to underwhelm, which again is going to just put more pressure on an already weak situation on an economic growth perspective, which is why we do believe that they are already in a recession. Italy manufacturing confidence indicator right in line with estimates. Italy consumer confidence, nice little bounce, but still at the lows when you're looking at it versus 2020. Again, we do expect this to be fairly stable at these levels. It's just when you look at what's it called? When people go visit places, tourists. When you look at tourists, tourist flows are gonna be slow, gonna be a bit underwhelming, and that again is going to impact some of these different countries, especially with Spain being a huge tourist destination. But the other side of the inflation story, and again, that slowdown and that confidence in spending, Italy HICP expected at 6.7%, came in at 7.3%. Again, that reacceleration. France didn't miss a beat, coming in at 5.8%, right in line with expectations, but again, moving in the wrong direction when you're thinking about where they sit right now, with consumer spending on goods in France, and this is on a euro perspective, is negative. So on an actual value percentage, it's down, which means that real spending is even lower, which again is showing that wrong move in April, which we see accelerating in May. And then another fun chart is the French PPI year over year, coming in at 27.8%, and again being that driver for additional inflation. Then you look at German consumer confidence just nosediving, falling from expected to be at negative 25.5, came in at negative 26. And if you look going back to 2005, this is the lowest it's ever been, taking out the pre-COVID, the COVID low. And then France consumer confidence seeing something similar. They obviously had a much bigger issue during 2008 and 2011 during the European crisis. But the one thing that is similar, it's below the COVID lows, which again, that consumer confidence falling, wages not keeping up, inflation going parabolic, producer prices going parabolic. And this is where we continue to see the pressure on the European economy. But because there's been 130 months since the ECB raised rates, that there's very little they can do because the law of diminishing returns. You have to tighten to be able to loosen and have a big impact. Otherwise, again, you minimize how far that dollar, or in this case, that euro can go. And that comes down to utils and all those fun micro, macro, college and university type numbers and definitions. And that's where that negative piece of every new euro just doesn't it actually has a negative contribution and a negative util, and that's where we continue to see these pressure points. So that's what we have for you on Europe. And now in the next segment, we're going to go deeper into China and, again, what is happening in the Asian continent. But we really want to look at where is PMI, where are leading indicators, and how much is stimulus really going to help the Chinese economy.